This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Tired of tariff talk, doji talk, Fed talk? How about hearing from actual companies and their take? Up next, first quarter earnings reporting season has brought hits and misses, but it's refreshing to focus back on earnings, revenues, and business prospects. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. Another very newsworthy week, like we haven't had enough over the course of the last couple months. I'll get to that in a second. Also, as mentioned, we're about 2/3 to 3/4 of the way through first quarter earnings reporting season. Really want to make sure I leave some time for bringing you the latest on what we're hearing from some of our top holdings. But, my message over the last couple months, and I think probably from my colleague here, Chase Hinderstein, as well, is that the what tends to matter, for us at least, more than the why. In other words, people spend 95% of their time, and certainly the financial media does, trying to determine causation for what's going on. And my point is, listen, causation matters, but what matters a lot more is what is actually happening. Because that's how we're going to think about risk and reward, what is actually happening, not in the why behind it. And the corollary to that is, I've been through a number of major downturns in my career. This is not my first rodeo. Dot-com bubble, 9/11, COVID, financial crisis, all those things. And certainly the circumstances, the catalysts for the downturns are different each time, but the market behavior is actually quite similar in many cases. And that's kind of been the takeaway. And really, recent events have not dissuaded me from that take. We had that, I guess, yesterday, or maybe I guess it was Thursday, was the 1-month anniversary of sort of the trough, at least for now, hopefully it's the trough, of this current sort of tough cycle, for lack of a better word. The S&P 500 was down roughly a little over 19% from its February highs as of a month ago. And since then, it's been quite a recovery. The S&P has actually risen roughly 13% since that low. That's the 11th best rolling 1-month performance over the last 10 years, according to FactSet. But this week was kind of an example of the other common, pattern that we see, which is that initial bout of volatility can give way to sort of a grinding back and forth period. In other words, you get the waterfall decline, right, which in this circumstance was sort of roughly associated with quote-unquote Liberation Day and sort of the shock that the tariff environment was going to be much more harsh than what a lot of analysts and certainly Wall Street had modeled for. And then once there was the idea that, hey, listen, maybe we start to get some trade deals, maybe the China-U.S., essentially a trade embargo will thaw at some point, that was really the catalyst for a rally, right? 9 days in a row the S&P went up. And of course, a lot of that was sentiment had gotten so extreme in a negative direction that it was almost inevitable we get some type of bounce. But now, we've had the big fall, we had the big bounce. I think we might go back and forth for a while. I said a couple weeks ago, I thought the odds of a V-shaped recovery like we saw during COVID, I thought those odds were very low. Obviously, I'd be happy to be wrong, but I think we're going to go into a grind. Okay, that's what's going to happen. And a lot of it's going to be, of course, headline related. This week was a good example. I mean, just on Wednesday, for example, we hear that Scott Bessent, Treasury Secretary, is going to travel to Switzerland this weekend for discussions with China. President Trump says the same afternoon, literally the same afternoon, that he will not come off 145% tariffs on China. Maybe that's negotiating, maybe that's bargaining, I don't know. But the point is, we're going to have that type, in some cases, antithetical news releases in the same day that are going to keep us bouncing all over the place. And of course, we got the news on Thursday of a trade agreement with England. So a lot going on. And I'll talk more about this when I talk a little bit more about individual companies. But companies have started talking about the tariff impacts on their businesses, but it was much more difficult to quantify is the possible influence on demand. Companies just don't know the extent to which consumer demand will drop off and the extent to which the American brand may be damaged. I mean, I know we don't like to admit that, but there's a lot of pushback around the globe about buying American brands. So stay tuned on those things. So I do want to talk a little bit about kind of what's going on in the markets and the economy. One just sort of interesting, somewhat of a side note is, again, I've been saying how patterns tend to be fairly consistent in downturns. Well, another pattern that's been fairly consistent is the presidential cycle. I think I said this all the way back in October, maybe it was September, that typically the first year of a presidential cycle, you have, particularly the first 6 months of that first year, you have a lot of volatility. And it's not really a stretch to see why, right? The new administration comes in, they want to shake up what the past administration has done. Now, obviously, this time around, it's been a little more severe than maybe some of the other transitions we've seen, just because of the nature of President Trump and Elon Musk and what have you. But still, pretty typical cycle. According to Piper Sandler, during the first year of a presidential cycle, this is going back, I think, to 1926, annual returns have averaged about 6.5% for the S&P. However, they've also averaged about a 16.5% drawdown. Well, what did we see? We saw about 19%. So what we saw a month ago is completely in keeping with the average first-year kind of track record of a new presidential administration. Now, obviously, we don't know what the future holds. We don't know if those were the lows or if we're going to break to new lows. But for now, it's been pretty consistent. I'll also offer that Piper Sandler also says that once the lows were in place historically, again, the hope is that those were the lows, the S&P posted average gains of almost 13% and 12.5% over the ensuing 6 and 12 months. We'll see. Okay, stay tuned on that. I do want to talk, obviously, about the Warren Buffett news, and unless you were living in a cave, you might have heard that towards the very end of his annual Omaha shareholder meeting, I mean, it was like 4.5 hours in, he drops the bomb that he'll be stepping down as CEO at the end of the year. So I want to talk a little bit more about that. But just in the meantime, I will tell you, one of my favorite quotes from Buffett is, and I'm not sure when he said it, but I'll just quote it to you. "The stock market is a device for transferring money from the inpatient to the patient." Think about that for a second. And think about what's going on recently. And I thought of this not just because of Buffett stepping down, but also because I read an article in the Wall Street Journal that highlighted a new study showing that the median investor spends just 6 minutes researching a stock before buying it. 6 minutes. I'll bet. And that's median. So that means a lot of people are just seeing something, seeing a headline and going ahead and investing money. And relatedly, the average holding period for a stock has dropped from roughly 8 to 10 years back in the 50s and 60s down to just a few months. So essentially, people aren't even doing research, and even if they are, they're probably not investing in the business. They're buying a stock price essentially and hoping for a quick turnaround. Obviously, I'm generalizing. A lot of people don't do that. Our clients don't do that. You don't do that as our listener, but a lot of people do. I do know that Buffett also said in a recent meeting, quote, "Nobody knows what the market's going to do tomorrow, next week, next month, but they spend all their time talking about it because it's easy to talk about. But it has no value." Think about those two Buffett quotes as you head into the rest of your weekend. I've said this for a long time, and I'll continue to say it. I'll quote some stats from, this is FactSet. Going back to 1950, they looked at how often the S&P 500 was higher over various holding periods. On a day-to-day basis, it's a coin flip. Higher 51% of the time. Go out a week, 57%. A month, 62%. 6 months, 70%. A year, 74%. All the way out to 10 years, 93%. 20 years, 100% of the time. Past performance is no guarantee of future results, but that's what the historical precedent is, according to the S&P 500. So when people tell you that the stock market is a gamble, They're right on a day-to-day basis. But over time, it's the opposite of gambling. With gambling, the longer you're at the table, the worse you do. Why do you think Vegas casinos give you comps? Give you credit for future travel? They want you to come back because they know the longer you're sitting at the table, the more money you're going to cough up. Stock market is literally 180 degrees from that. Exact opposite. All right. Enough on that. I do want to transition and talk a little bit about the current situation, just some observations. I don't want to get too much into an economic deep dive here, but I just wanted to highlight a few things that are sort of top of mind for me. And I've talked a lot about this over the last few weeks. I think Chase has as well. The sharp difference between what's the so-called soft data and the hard data. So the soft data are sentiment readings, essentially what I kind of tell you I think. The hard data is what I'm actually doing. So in other words, the soft data, somebody might say, well, I can't trust this administration. I don't like what's going on. I don't like Musk. I don't like Trump. But then they might be still going out to dinner that night or taking a trip that night. That's the difference. And that's kind of what we've seen. If you look at the most recent Consumer Confidence Index data, I guess it was the April data, the present situation, which is an assessment of current business and labor market conditions, was pegged at 133, which is well above the survey's historical average. Meanwhile, the expectations index, based on consumers' short-term outlook for, quote, income, business, and labor market conditions, fell to 54, which is the lowest level that I could see since 2011. Okay, so think about that difference. In fact, if you divide the present situation index by the expectations index, it's never been more elevated in its entire history. Again, this is according to the consumer confidence data. So who knows you can form your own conclusions there, but people are spending as if, you've seen a little bit of drawdown in spending, but nothing significant. People are spending like there's nothing wrong. But their forecasts, or at least what they say they're going to do, is much more dire. If you go back to, this is from Callie Cox Media. She's a blogger that I follow pretty consistently. According to her, every recession since 1970 started with worries about the future, but not necessarily concerns about the present. In fact, future expectations have started falling an average of 12 months before confidence in present conditions started to slide. So what is what's the fulcrum here? What's the tipping point? When do people actually start changing their spending habits? And as Callie Cox suggests, and I would concur, it's when they lose their jobs. It's as simple as that, folks. If people have jobs in this country, they're going to spend money. And that's been the track record for a long, long time. And you should argue that maybe shouldn't be the case. Maybe people should save money. Maybe they should pay down debt. Maybe they should put money away for their kids. That's not what people do. When people are working, they're spending. So I say this because it's really easy to get lost in all the data releases because there's a ton of economic headlines coming out. If you just want to keep it simple, pay attention to the jobs data. That's going to give you the biggest symbol by far. Don't get too dragged down by the vibes. Watch the jobs. And the jobs data has been pretty resilient. We all know about the DOGE cuts, the U.S. government and federal worker job cuts. We all know about those. We all know that people are worried about tariffs and the potential impact there. But for now, things have been pretty resilient. I will say the longer-term data is a little more concerning and do point towards a cooling. So this is according to U.S. non-farm payrolls. Total jobs in the U.S. increased about 1.2% over the last year. That's the slowest growth rate since March of 2021. Below the historical average of about 2%. And there are only 110,000 more job openings than unemployed people in the U.S. That's the smallest differential since spring of 2021. Versus there were over 6 million. The peak was 6 million in March of 22. So 6 million down to 110,000. So those are kind of the longer-term trends, and those are the things that we're going to be watching. That's why certainly the Fed, I think, is in a tough spot, right? Because they said on Wednesday when they came out with another pause in rate cuts, they said the risks to both sides of their dual mandate have risen. What's their dual mandate? To keep unemployment low and to keep inflation low, essentially. I'm paraphrasing, but that's essentially their dual mandate. The risks to both have risen. So I don't want to get too much into economics. I will say when I looked at the first quarter earnings reporting season so far, we're most of the way through. According to FactSet, the earnings so far have actually been much better than expected, almost 13% earnings growth versus expectations for 7 or 8 coming in. Obviously, that's in the rear view mirror, so people aren't that concerned about it. But I do think it's worth saying that companies were in pretty good shape coming into this period. Profit margins close to an all-time high, according to FactSet. I also think it's interesting that according to the Federal Reserve Bank of Dallas, they do a survey of businesses, both public and private. And the vast majority, over 75% in aggregate that they polled, say that they'll be passing through cost increases to customers. 75%. So what does that mean? That means that companies are going to do everything they can to defend their margins. And it's almost inevitable that there's going to be some inflation. The trick will be, is it transitory or does it get embedded in the system? I think we can live with a one-time kind of adjustment to prices, tariff-induced adjustment, but does it become embedded? Remember, we just came out of a period where the Fed told us that COVID inflation was transitory, and it wasn't. Stuck around for a lot longer than people thought. But I will say from the market reaction, the market seems to be more concerned with growth than inflation. Yes, longer-term interest rates have gone up, but not that much. And economically sensitive areas in the market like energy, some of the manufacturers, consumer discretionary stocks have underperformed. So the market is more growth concern than inflation concern. And I'll also leave you with one last thing. Remember, on average, stocks have bottomed in price. This is according to Ritzold Asset Management, roughly 9 months before earnings do. So the market can push higher while the street continues taking down their earnings forecasts. So don't necessarily think that earnings have to be improving significantly for the stock market to start doing better. Stock market has a way of looking forward. So this is not to suggest that we're at the bottom, that it can't get worse. It's just to suggest that the market seems to be well cognizant of some of these risks. Everybody and their brother knows there's going to be threats to corporate profits. All right, enough on the macro. So I mentioned Warren Buffett, and I mentioned about 4.5 hours into the Omaha shareholder meeting, he drops the bomb that he'll be stepping down at the end of the year. Importantly, he's not leaving Berkshire Hathaway. He's still going to be chairman of the board, presumably indefinitely. So he'll still be a sounding board. I wanted to say a few things about the transition there. Again, Berkshire Hathaway, just to be clear, we do own the shares in our client accounts, the B shares, BRKB. I am a shareholder myself, so evaluate that. Consider that a conflict of interest. If you're not a client, make sure that you do your own due diligence if you're considering a position in Berkshire Hathaway stock. If you are a client, I think you can feel comfortable that we have done our due diligence and feel it's appropriate for your particular portfolio. But I just want to highlight a couple things. One is the ungodly high returns that Buffett has earned over time. So get this, folks. This is an unbelievable statistic. According to FactSet, from 1964 through the end of last year, that doesn't even include this year where he's had a good year so far, but over that, 60 years, 5,502,284% return. I am not lying. And that is twice the S&P, roughly 20% versus about 10% for the S&P. That's why people consider Warren Buffett legendary, and that's why there is probably little skepticism out there that anyone going forward can recreate that. But I will say this. I think the transition is about as orderly as it can be. So he announced that Greg Abel, A-B-E-L, will be taken over as CEO. Abel's been around for a while, so he came in 2018. I think he was actually a former accountant for a company called Canadian Prairies and came to Berkshire through acquisition. Berkshire Hathaway acquired the company he was working with, and then he built Berkshire Hathaway Energy into one of the company's biggest businesses. So ABLE has been around for some time, again, since 2018, and pretty much Buffett revealed in 2021 that he would be the heir apparent. So ABLE has had a number of years to get used to kind of being involved in the company. And keep in mind, he was only involved in the non-insurance businesses. The guy who's been running the insurance businesses is Ajit Jain, Jain. So that is another source of continuity. None of the leadership on the insurance side is really changing. The thing I like about ABLE is, and is worth noting, ABLE really oversees not so much all the stock investments, but the actual businesses that Berkshire Hathaway owns. So he's been in charge of Oriental Trading, See's Candies, Fruit of the Loom, Benjamin Moore, Clayton Homes. And Buffett, of course, was famously an kind of hands-off manager. ABLE, I think the difference that you might see here is ABLE's more of a hard charger. Now, I don't think he's going to get into the day-to-day operations of these companies, but he is definitely someone who's going to be more involved in driving productivity, driving earnings growth, helping them make strategic decisions, in my opinion. Because even Buffett would admit, and has admitted recently, that he hasn't been paying as much attention as maybe he could have. He said that a couple times over the past couple years. So I think that will actually be a positive transition for Berkshire Hathaway, a little bit more attention to those businesses. And also keep in mind that the actual investment portfolio, a good chunk has been managed by Todd Combs and Ted Weschler. Both of those gentlemen will be retained and presumably step up into a bigger role in terms of actually managing the portfolio. So I think you get what I'm saying. If you like Berkshire Hathaway, if you own Berkshire Hathaway, I don't think you're going to see a lot of change there in terms of philosophy. Certainly, they're in a position where they have over $300 billion in cash, and Buffett really made his reputation as an asset allocator, somebody who is good at deploying cash. So we'll have to see how that changes under ABLE. There's talk about them paying a dividend at some point, maybe buying back more stock. We will see. But the stock market is telling you they're not that concerned. The stock's only down, maybe 2.5% since the announcement, still up over 15% for the year. So maybe it's a bit of a wait and see. But if you are a shareholder, I don't know that there's a whole lot of difference, but we'll all find out together. So just want to give you a little bit of an update on Berkshire Hathaway. Up next, stick with me. I want to transition a little bit from the general to the specific. I promised you I'd reserve some time to talk about some individual companies. I want to make sure I do that. Back in a second. New administration is certainly upturning the status quo, but you don't have to be a disruptor in your own portfolio. It could be wise to keep calm and carry on. Tune in every week as we discuss the latest financial trends and how to filter out the noise distracting you from sound portfolio management. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. As promised, I want to highlight some of what we're hearing from some of the top holdings in our client portfolios. As I mentioned with Berkshire Hathaway, I'll say it again. All the names I mention are names that we own in our client portfolios. And in fact, I own all these names personally, which is a conflict of interest. So if you're not a client, make sure you do your own homework. I can't manage through the computer. And if you are a client, you can assume that we have done our due diligence, feel that they're suitable for your portfolio. So as I mentioned at the very top, this has actually been, for me at least, a rewarding, for lack of a better word, couple of weeks, because I don't know about you, I get kind of sick and tired of hearing about political headlines, policy headlines. I really wanted to hear what actual companies were saying. I've said for a long time that companies, they're designed to manage through all kinds of cycles, different political cycles, economic cycles, interest rate cycles, geopolitical cycles. They're not going to be as volatile as maybe what the headlines would suggest. So I'm very interested to get the take there. And I'll start out by highlighting some of what we heard from some of the Magnificent Seven companies, which, of course, were responsible collectively for about 55% of the gains in the S&P in 23 and 24. But all of them, all seven, suffered big-time drawdowns over the first 3-4 months of the year. I think the average drawdown was somewhere between 25 and 30%. So it's been a bit of a ride here over the last couple of years. But for the most part, they found their footing to a degree, and a lot of that is on the strength of the quarterly results that we just heard. So Microsoft, I'll say one other thing. There's a pretty big difference within the Magnificent Seven about their trade war and tariff sensitivity, and we saw that. I'm not going to talk about all seven today, but certainly Microsoft and Meta and maybe Alphabet fared better than Amazon and Apple. A lot of that is directly attributable to their trade and tariff sensibility, or sensitivity, I should say. Microsoft, I think the big story there was some concern about their Azure, A-Z-U-R-E, their cloud software platform. In the most recent 2 quarters, actually, there was a little bit of deceleration of growth. They sort of put that concern to bed in their most recent quarter, at least for now. The Raymond James analyst said that Azur's figures were strong across the board, and in particular, an accelerating AI contribution. Okay, so that, again, in his mind and other people's mind, that showed that some of the concern we've seen about a slowdown in spending on AI infrastructure. There was rumors of them canceling data center leases, for example. A lot of those concerns were probably overblown. So AI demand remains robust, and even their non-AI businesses were robust, gaming, what have you. So that was probably the biggest takeaway from the Microsoft quarter. I would say in general, software sales, I would expect to be a little bit less tariff sensitive. So I think in their report, according to Raymond James, the positives outweighed some of the potential negatives. The negatives, of course, are just overall, I think, economic climate and competitive climate, right? There's that kind of race to capture market share. They're competing with Meta. They're competing with Alphabet. That's a significant threat. I don't think the tariff threat is as big for Microsoft. And the valuation is fairly demanding. They're still trading over 34, 35 times earnings. So Microsoft needs to have continued execution like this to justify the multiple. Meta, somewhat similar. I think that the big story that we heard with Meta was that their CapEx budget, their capital expenditure budget, actually they raised it again. So again, there was concern that these companies may be overspending, and there's some concern around the return on investment with all this AI spend. But that's not shared by the CEOs of these companies. And, I think the fact that Meta very confidently talked about the opportunities in AI, talked about their budget, talked about their exposures. Again, this is from the Raymond James analyst. That led to some firming up of the stock from what had been almost a 30% correction from the highs. And they talked about AI monetization, how they can actually make money off of that, and they were pretty articulate about a pathway there. So, again, it's not the cheapest stock in the world at about 26 times next year's earnings, but given their double-digit growth rate, to trade at a slight premium to the S&P doesn't seem to be out of line. So the risks would be similar to the risks with Microsoft. The overall economic landscape, particularly advertising. In a recession, advertising budgets are one of the first things that companies cut. They probably shouldn't cut them, but they do. And that would certainly affect the profitability of Meta. So think about that. But Meta and Microsoft, like I said, a little bit less trade war sensitive than some of the others. Alphabet, formerly known as Google, they've been a very interesting story recently. They're the cheapest of the Mag 7 by far, trading maybe 16 times next year's earnings. I think that the real positive on Alphabet is, not only the low valuation, but the fact that the low valuation probably, I say probably, accounts for some of the risks ahead of them. So what are the risks? Well, one of the big ones is the Department of Justice apparently wants to break them up. Okay, so they've been accused, it's a little more nuanced than this, but in general, they've been accused of having a near monopoly in search. Okay, even the word Google has become a verb, right? Just Google it, right? And so they're under pressure to potentially having to divest some of that sort of search-related business. But ironically, or even contradictorily, on the other hand, they're facing a significant threat from AI. In other words, people are using AI instead of traditional search engines to find content. So here's the Department of Justice saying that they have a monopoly. Meanwhile, the real competitive landscape is from AI. In their most recent quarter, they beat on the top line, they beat on the bottom line. There's a lot going on there, even beyond AI, right? YouTube, Waymo, their autonomous driver business is really starting to accelerate. So there's a lot to like there. But I think the key fact is, and I will highlight Deutsche Bank's research on this. Deutsche Bank came out and said that they believe that AI-powered searches are going to be additive to search query volume, not dilutive, additive. That's the key point. So it's quite possible that they do lose market share in search, either via trust activity or just losing it to AI, but that the AI will eventually actually help search volume, not to mention they have their own AI product. So there's a lot going on there, and this week was a good example of that. Apple comes out and says, yeah, Google's losing market share. Google comes out the next day on Thursday and says that's completely untrue. So there's a lot of back and forth, and Google stock has been volatile. But if you are patient, I think it's an interesting name for you to consider, especially, like I said, at 16 times forward earnings, probably discount some of these risks. The risks are, as I've mentioned, antitrust efforts and significant competitive threats. But Alphabet, I don't think should be written off at this point. I'm not going to spend too much time on Apple, but I will say they did acknowledge, pretty significant tariff exposure, as much as $900 million just in the next quarter. So they're going to have to deal with that. I think I've mentioned before that Apple, in the last Trump administration, rerouted a lot of their supply chain from China to Vietnam. But now, of course, we have significant tariffs on Vietnam. So they're kind of in a no-win situation from a supply chain standpoint. Very difficult for them to onshore manufacturing back here to the United States. That's probably not realistic, at least in terms of being able to really move the needle there over the next 5 years. So they're going to have to navigate that. Certainly they have the margins to do that. Their margins were well over 30% in the most recent quarter. So they have some room there. The service side of their business, remember all the Apple Pays and the music library, service business has been doing great. So regardless of whether you and I go out and buy a new phone, we're probably keeping our phone, right? And we're probably paying for those services. The profit margins on that side are over 75%. So Apple has a lot of levers that they can pull. They're buying back their own stock. The risks are pretty clear. Their margins could be impacted on particularly on the phone side, and we'll see what happens with pricing. I mentioned this a few weeks ago. Do they actually raise prices? That remains to be seen what their end game is there. And then I would say the other risk to Apple is their valuation. They're still trading over 30 times earnings. So unlike Alphabet, unlike Meta, there isn't as much of I don't want to say a safety net, but they're not protected as much from a reasonable valuation. So take that as you will, okay? I want to transition a little bit. Uber has been a name that we've added to our portfolios within the past few months. Again, it's another name that I own personally, so consider that. I think you all know who Uber is. The story with Uber, for me, is I'm a little less concerned about kind of their quarter-to-quarter results. And I say that because the overall trend is sort of up and to the right. So I read a nice piece from Evercore following their earnings. They missed slightly on new bookings. They missed slightly on revenue, but they were still up high teens year over year. Okay, so there's a little bit of a deceleration there, but Evercore believes it was largely due to a moderation in insurance costs, which are a pass-through in pricing to consumers. So they basically did less pass-through. That was sort of responsible for the revenues. Not as really concerned about that. I think that will bump back and forth. The bottom line is their consumer demand trends remain consistent, no indication of deteriorating demand. Their delivery business, Uber Eats, not only has traffic been strong there, but margins have improved significantly. I think this is really important because if we do go into a more significant economic slowdown, I have to believe that, maybe people wouldn't pay up as much to have, a sandwich delivered to them. But if they can keep the margins up, if they can keep the profitability of that business up, they'll have pretty good operating leverage whenever the economy picks up at some point. So the margin story is very attractive. And I think the other big thing about Uber, again, according to Evercore, is really the profitability and growth of the company at scale. They're a large company. And I don't know too many companies that can grow at 20% or better with a profit ramp of like 30% in terms of free cash flow growth year over year, that trade at a discount to that growth rate. They're trading at a pretty, I just mentioned those Magnificent Seven names. They trade cheaper than all those companies, despite a much faster growth rate. So just from that perspective alone, I think it gives you the ability to kind of ride out short-term volatility. The other thing I would say is the autonomous vehicle growth is really starting to happen. In this area, Washington, D.C. area, Northern Virginia, you haven't seen a lot of it, but they have over, I think it's 19 partnerships now with autonomous vehicle companies, including Waymo, by the way, which is Alphabet's autonomous vehicle business. And Uber, of course, is doing the infrastructure, sort of the logistics behind it. So they're not producing the cars, but they're providing sort of the infrastructure for it. It's a real thing, and that business is taking off. And if you look at where the flagship cities are in the U.S., like San Francisco, Austin, the growth has been dramatic. So that is just starting to be a monetizable business, and I think could be a significant tailwind over the next few years. As I mentioned, the risks are pretty clear. I think it's mostly macroeconomic risks. If people are going out to restaurants less, if we have less international tourists coming to the U.S. who need to be driven around cities, those are all risks for Uber. And there's always the competitive policy threat, when you have Elon Musk involved and supporting Tesla. There's always a little bit of a floating landscape there in terms of autonomous vehicles, electric vehicles in general. But again, I think the valuation gives you some support there. So see if that makes sense for your portfolio. The last one I just wanted to mention is ABBV. Pharmaceutical stocks have had a real bumpy time recently. As with semiconductor chips and some other industries, they're sort of at the epicenter of this tariff situation. Trump has talked loudly about a new tariff regime for pharmaceuticals. So there's a lot of overhang there. But AbbVie, symbol ABBV, is another one that really delivered on the bottom line and the top line. According to the Raymond James analyst, they raised their 2025 guidance. Several of their key growth drivers, their oncology drugs and their immunology drugs, outperformed. So remember, this is a company that used to have 70% of their sales come from Humira. It's a drug that went off patent, so those sales are in perpetual decline. But they've done enough on the R&D side. Not only have they replaced those lost sales, they're accelerating forward. So the other thing I would just say about AbbVie is even though they didn't quantify tariff exposure in their quarter, they spoke to the fact that they have 11 U.S. manufacturing sites, and they have plans to build another 4 sites to the tune of about $10 billion plus over the next few years. So they may get caught up in some temporary tariff-related volatility, but they certainly have the wherewithal to route more production here domestically and expand that production. And they're trading at a fairly reasonable multiple, a little over 13.5 times this year's earnings. So there are certainly policy risks there. The Kennedy Jr. administration is not particularly friendly to pharmaceuticals in general. So there'll be some headline volatility, but I think AbbVie is the type of name that is showing that they can likely deliver long-term bottom line and top line growth, really regardless of the backdrop. So be aware of the risks, but I would continue to keep an eye on ABBV if you're interested in some more pharmaceutical exposure. I think that I'm going to leave it there for now. When I come back in a couple of weeks, I do want to talk a little bit about the bond market. I've been sort of neglecting what's going on with bonds, and there's been a lot going on with bonds, so I definitely want to pick up on that. Remember, just to reiterate, those names that I mentioned, we own for our clients. I own personally. You should consider that a conflict of interest, and if you're not a client, please make sure you do your own due diligence before jumping into anything that I've talked about. You got to make sure it's right for your particular situation. Hope that was helpful. As always, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.